All right, everybody. You know what? How do you pick your stocks? Because you know what? In today's world, in today's market, I don't even know if we need to look at fundamentals or valuations or even charts. Hell, just pull up your Facebook, your Instagram, your TikTok, or Twitter and look at what VCs and what CFOs are tweeting about. And that's how we buy stocks. It's nonsense. What the F is going on? All right, so on today's show of What the F Happened, a weekly show where we literally go on rants. I'm joined with Steven, and Sodi's going to be chiming in once he gets his trading up and going. And we're going to talk about the craziness, literally, that's our only word for it, the craziness of what happened last week in the markets. Steven, I mean, what was last week like in the market? I mean, outside of Bitcoin falling off of its $40,000 or $42,000 high down under 30,000 to the stock market shedding almost 1,000 points and everybody thinking it was going to continue going all the way down to the next level, which is about 2,700 on the S&P. I mean, crazy week. Where should we even start?
I don't know, because then we open up this week on Monday and things are back through the roof and going to the moon. So it's been crazy, that's for sure. I think, like you said, you opened up, man. Just get on the internet, get on the chat boards, and find out what main stocks are trading, because that seems to be where all the hype is right now. It's just absolutely bizarre. GME's still going into the moon, and crypto's going all crazy. And we go from a week 30,000 up to 40,000 in a week, then back down below 30. Then it's all over the map, man. It's craziness.
Yeah, and I don't even think anyone was out tweeting. I didn't see Elon Musk tweeting. I didn't see anyone else sending out any tweets like, oh, Tesla's overvalued and Tesla tanks, or, I'm buying Dogecoin and Dogecoin goes through the roof. I mean, hey, that's the world we live in. But you know what? A lot of people are just like, well, I'm going to get it while the getting is good. And I agree with that. But there's also a lot of people out there making stupid decisions by buying into this hype, buying into the FOMO, buying into this crazy euphoria that this is never going to end. It's going to end. Who knows when? We can't time the market. If you asked me last week, based on price movement, based on the megaphone pattern, I would have said the markets are going to continually, just keep selling off. And I thought we would have seen the S&P go from the 4,000s down to the, the mid 2,000 range, which would have been a huge sell-off, over 30% correction. But that's not what happened. It bounced and it went back up. And a lot of people are like, wow, well, this is the normal. No, it's not. This is nothing even close to normal, but it's not something that hasn't happened. And, Stephen, the funny thing is I'm a bit of a nut and I study history primarily 1918 to 1934 was about the range I've studied the most. I've read countless books on this. I've watched all sorts of YouTubes on this. And here's the thing. Last year, I think it was last year, I'm almost losing track of time. We had COVID. Was that last year or was that the year before?
That was last year, yeah.
So last year we had COVID. The markets in a month's time shed 30+%, okay? Because of COVID, the country shut down, the world shut down, and the stock market sold off. And a lot of people sold off with the market selling low. Some people were buying during that period, which was really smart. And then the market did what's called a V, and it bounced back. And now we're at all-time highs. Valuations, PE ratios are through the roof. Actually, valuations don't even make sense, but PE ratios are higher than pretty much they've ever been. So when you really look at this thing, and PE stands for price to earnings, when you really look at this, you got to make really an assumption. You got to make an assumption that we are truly in a bullish type market based on 100% speculation. And not only that, I'll tell you why this is happening. Last week when the market sold off, the market should have pushed through that level, but markets work in very predictable patterns, okay? Not only a 10-year pattern, a 45-year pattern, and a 90-year pattern, which will cover those bigger patterns, but they also work in support and resistance levels. And if you follow them and you look at the megaphone pattern, that support and resistance level goes from this big to this big to this big to this big. Today, it's like that big, if you can kind of see. It's so small. So the stocks and the entire markets are just bouncing off of that floor up to the ceiling. Why? Why didn't it go the other direction? Well, there's obviously some hedge funds and a lot of people that don't want it to go down. So what they're going to do is they're just going to plow a bunch of money in and bounce it back up to the next level. It's a trap. I've been saying this for a while. It's a bull trap, and a lot of people are going to get incredibly hurt with this. So what is your take on that? And then let's get into some of these topics that we got today. So we got some good ones.
Yeah, let's get into it. I mean, like you said, there's a lot of, this is WTF. There's a lot of uffery going around behind the scenes right now, and that's kind of helping keep all this up too. So you got to play in the world that we live in. So figure out ways to take advantage of it. Yeah.
So what I'm going to do here, and we got Sodi who has joined us as well. He's trading right now, so we'll bring him into the mix as we kind of go through this. And this is definitely one where I want Sodi's take on it. So what we've got is we've got some charts that I'm going to throw up on the screen here, and we're going to ask Sodi his opinion on what he thinks of this. You with us, Sodi? I know he's trading. It's about that time. We do this right when the market's open, but if you can see this, what we've got is we've got 4 different periods of time. So Sodi, just let me know when you're ready to rock and explain this. We got 1976, we got 1983, we got 2004, we got 2010. What exactly does this chart mean? And anyone on Instagram, you can't see the chart, so just listen up and we'll talk through it.
Did you let Sodi in the show? You might have to let him. I don't see his picture here.
Oh yeah, that would be my mistake.
There we go.
Oh, so that bud.
Yeah. So I guess the easiest way to explain it, especially the people who can't see the chart, is so what we're looking at is basically after we've seen a major low in the markets in 4 different periods. Now we're looking at 1976, 1983, 2004, and 2010 offers some major lows the market has seen. We've always seen, like Chris said, a V recovery. We've seen that kind of recovery this year as well. We've always seen this big rally in the markets that most people can't explain, but we get caught up in it. Usually what happens after that, and this is something that only time will tell if we're correct or not, is year 2 is a period of consolidation. So our big question is 2021, after the major rally of 2020, a year of consolidation or reversal? So this was a very interesting chart that actually shows us 4 different time periods where major bull markets, bull rallies, so to speak, began. And then after year 1 of those markets, year 2 has always been a consolidating time period. So again, it'll be interesting to see where this takes us, but it's good to know because again, if we look at history, if we look at previous patterns, we can see that there are always some similarities. So what we're seeing over here is after year 1, year 1's thrust, year 1's rally, is year 2 consolidation, and is that what 2021 is after all?
Well, it certainly looks that way because a lot of people, when they watch the news and they see what's going on, they think, oh my God, the market's just going higher and higher and higher. But really, this year, the market more seems to be in a sideways pattern, or as you said, a consolidation pattern. There's certain stocks breaking through, making new highs because Elon Musk, tweets about it. But I mean, AMC, GameStop, those are toxic. Like anybody trading and playing in that world, you're either going to make a bunch of money or you're going to lose everything because it's just a toxic world. But if you look at these charts, it really tells the pattern. I mean, that's 4 different patterns. And what comes next? I guess that's what everybody's asking. Everybody wants to know what's next. Are we going to continue to see a sideways consolidation period? Are we going to see, another bull market rally? Are we going to see, everything fall apart in a big correction? And I know you can't time the market, but what would be your best take based on these 4 charts on what is going to happen next into 2022?
So again, these are difficult markets, and like you said, nothing makes sense. What the fuck happened? So we have to be careful. I think this is time where, whether and there's a very popular saying on Wall Street, which I love, it goes, bulls make money, bears make money, pigs get slaughtered. So don't be a pig. So if you're whether bullish, whether you're, bearish, doesn't matter. Be smart. Know what the history says. Know what the markets are. Be able to understand it. Don't go all in with everything. Control your risk, And again, just remember, bulls make money, bears make money. Pigs get slaughtered. So don't be a pig. Just make sure that, again, same thing. If this is a year of consolidation, Maybe it's time for you to sit it out. Maybe it's time for you to wait to see where the market breaks, whether it be the upside or the downside, then trade it accordingly. But I think people make this mistake of, wanting to trade all the time, wanting to be in the market all the time. And I think that's rule number one, where if you're a trader or like a short-term investor or something like that, know when to trade, know when to get out of the market. So I think that's very important.
I think that's key because, Warren Buffett says it best. To make money in investing, all you need to do is buy low, sell high, and don't lose money. If you're buying into this craziness right now, AMC, GameStop, so many of these stocks, you're essentially and absolutely buying high. So then you have to decide, okay, if you're going to buy high, there's no problem. You can make money in these markets. You can make money in any market, but you got to have an exit. You got to know, where are we going to exit this market? I know you're a professional trader, and every trade you enter, you always have an exit plan, and you also have almost a contingent or a secondary exit plan as well. And if it's a longer hold, for some reason you take a long hold, which I know you're not doing too much right now, you're always hedging that. You're always making sure that there's protection against the downside. Can you explain hedging just a little bit? I know it's something you're an absolute expert in.
Right. So hedging basically means, limiting your downside risk or having some sort of protection if the market reverses. So in short-term investing or trading, it is more, protecting your downside. So if, at some point your losses will be capped. So your upside and downside going into the trade. In long-term investing, hedging is a way, like, if we take last year's drop as example, if you were hedged, yes, I'm not saying that you would have not lost money. I'm just saying the hedges would have paid for enough of the money that you wouldn't have had sleepless nights and be concerned that, oh my God, should I sell everything? You would have just stuck to your rules, followed along, and not have a problem. So hedging is a very simple way of saying protecting your investments. It's like insurance. It's like buying insurance on your investments. And you can do it plenty of ways. There's different stocks. There's various inverse ETFs. There's options. There's futures. There's a lot of ways to hedge. It just depends what's the right fit for you. But yeah, that's what hedging is. And I think it's interesting to me that most people, we buy insurance on our cars, our houses, renters insurance, health insurance, for our MacBooks, everything. But somehow for the one asset that people work their entire lives for, their retirement, there's no insurance in the market.
Absolutely. I love the way you said that. And a lot of people, when they hear you talking about hedging, they haven't heard of this before. It's brand new because most people just know, I buy a mutual fund in my 401k or employer sponsored plan, or maybe I bought a stock or an ETF in my brokerage, but they just blindly buy it just based on speculation or someone telling them to. They have no idea how to do this. So if somebody was brand new to getting into the stock market, we had somebody on Instagram here say, I'm brand new, like, what is the first step? What brokerage do I go with? Like, how do I do this? Well, if you're listening to us, the first thing I would tell you is probably your first step would be get educated. If you don't want if you don't want to pay an advisor, which I definitely would recommend not hiring an advisor and just learn yourself, because advisors are going to put you all in the market because that's how they get paid. They're not really protecting against the downside, and they're definitely not hedging. So what would you say to somebody that's brand new, looking at this, thinking, everybody else is getting in, I'm missing out? Like, what would you say to them on how they would get started?
Right. Again, like you said, education is number one. I think most people just want to dive right head in and think they can make money. You can get lucky every now and then. You can hit a trade, make money, think you know what you're doing. But remember, trading is a zero-sum game. So if you're making money now, at some point you will lose money and probably go negative as well. So the best way would be to seek out education. Now, of course, we know here at 1010, we do our mentorships, we do our coaching. That's a great way to get started because we start with absolutely beginners. But at the same time, it's important to just know, hey, this takes time. You can't just watch a couple YouTube videos and jump into it and think you know everything. You've never read about it. You've never looked into it. You don't know what valuations are. So I think seeking out mentorship or seeking out some sort of education from somebody who knows what they're doing rather than someone who's just trying to sell you something is very important.
I think that's huge, and we got Harold said pigs get fat, hogs get slaughtered, just like you said. Sean said on YouTube, not concerning at all. And then also, I love this comment because this is what everybody's trying to do. So we're going to hit this one heavily. Avery said, I bought 6 AMC, so that's the theater, just if you haven't been following it, 6 AMC at $10 and sold it at 60 because I know it's a cheap stock. And then he said, LOL. So I hope he's joking about that because AMC at its current value is not a cheap stock at all. Matter of fact, it's so grossly overstated that anyone buying it, you might as well look at yourself in the mirror and laugh your ass off at yourself because you're the joke. The joke's on you. But, so Avery made money. And everybody's trying to, when they look at the stock market, just like people were in 1926, 27, 28, and 29, everybody was like, I want to get rich quick. So everybody's looking for a get rich quick scheme. Like Avery, here on YouTube said, he bought AMC at $10 and he sold it at 60. So he did do well. Imagine if he had 600 shares of AMC. But that is such a rarity in such a strange environment that we're dealing with these AMCs and GameStops. I mean, that isn't the norm. And a lot of people are starting to think that that's the norm. But getting wealthy or making money in the stock market is not a get rich quick thing. It's a get poor fast thing, in my opinion. Like, what would you say to what Avery said here?
Yeah, that's well said. Get poor fast scheme. I like that. Again, if he got out when he got out, that's great. I think that's what the biggest problem is. People get in, but they don't know when to get out, whether it be the upside or the downside. I think number one problem of anybody, whether it be new investors, even professional traders at some point go through the same thing where it's more like, oh, okay, I'm in the trade. Now when do I get out? I'm up 10%. Okay, I'll wait for another 5%. Okay, now I'm up 20%. Well, should I wait for another 5%? It might hit 25. Next thing you know, it's up 50%, and you're like, oh, you know what? This could go to 100%. I think we keep playing that chasing game, and then that 50% winner turns into a break-even trade. So we're like, okay, you know what? Let me just get 5% so I can pay for commissions. Or next thing you know, it's down 5%. Now you're asking the market for break-even. And then it's down 15%. You're like, you know what? Should have just taken a 5% loss. So on and so forth. Next thing you know, you're down 50% or 90%, and you just turn a winner into a loser. So I think just not knowing when to get in or when to get out, whether it be the upside or the downside, is the number one problem. Again, it doesn't matter what you buy or sell. Even if we're in a market where we have crazy trades like these all the time, if you trade those, that's great. If you're making money, that's great. But just know when to get out. Just know when to get out. I think that's the number one thing. You can make money on anything. And again, like I said, bears make money, bulls make money, pigs get slaughtered. So don't be a pig. Like, it's the same thing. Just if you know at 60, this is good enough, I'll get out, I'll take my profits, and I'll wait for another opportunity. Fantastic. If you know, hey, you know what, 25% loss is the max I can take, all right, get out. That's great. But don't get greedy and turn a winner into a loser. Trust me, you'll hate yourself.
Yeah, let me give a shout out to Avery real fast. She's killing it, and a lot of stuff that she's doing with money schools. So that's awesome. And like you said, it's a zero-sum game. So she bought at 10, sold at 60. Well, by selling at 60, what had to happen on the other side of the transaction? Somebody had to buy at 60. So while Avery's laughing all the way to the bank with the profit she made, this other person's now holding that $60 bag. Like, how am I going to sell this now for 100? Right? Like Sodi just said. And so be very, very careful with that kind of thing.
I love that, and that's a very good point. Everybody has to understand that for everybody that's, buying, or everybody that's selling a stock at a price, there's always somebody buying. There's no other way around it. Somebody's got to be buying when somebody else is selling. Otherwise, you don't have a market. But, like that being said, somebody bought that at $60. Avery made money. Kudos. Good. I mean, we are the biggest cheerleaders here at 1010 and Money School for anyone making money. Like when that whole GameStop thing was happening and they were, the Reddit investors and the tweets and everything else that were going on, were driving that thing to the moon. We were the biggest cheerleaders for them making money. But the problem is, when everybody exits, Avery exited at 60 and some people were exiting at 500 or 400 on GameStop, somebody was buying. There was some poor soul buying at $400 or $500 on GameStop. GameStop, a stock that in its best day in the world is worth $20 because there's not people lined up for miles down the street to buy Pac-Man or Mario Kart or whatever the hell they sell. Does anyone even know what GameStop actually does in today's world? Because last time I checked, most video games are bought online. Is that through GameStop? I don't think so. So
and there's a lot more to it too. I mean, it's shorts maybe having to buy at those prices. So again, there's a lot that goes into trading. Know what you're doing, get educated for sure.
yeah, but there's another thing too. I saw a story, when that whole GameStop thing was going on, there was a woman who, it was maybe a made up story, but I'll just read it because it was off the news. There was a woman who took her children's college fund and invested it all into GameStop, thinking it was going to keep going up and up, and then it tanked. So she pretty much lost her kids' college fund. Like, that's the reality. Remember, like, for some people that are experienced, they're making money. For other people, they don't know what they're doing, and they're just buying into the euphoria. And unfortunately, that buying in or that losing of money sometimes means somebody's college tuition is gone. Somebody's retirement now has to wait another 5 or 10 years. Like, that's the reality, and that's what everybody needs to be careful with. And Corey said, this is the last one I'm going to ask you, Sodi, and then I'll let you get back to trading. But Corey said, what role, and a lot of people think that they have a lot more control and power, but what role do consumers being directly involved in the markets like Robinhood, Webull, etc., have in market behavior? In other words, how much control do the markets or do people's trading have in the markets?
All right, that's a great question. So I'm going to take a little bit of a theoretical approach here. Okay, so let's understand really quickly that, Stephen and you said that there's a buyer for every seller and there's a seller for every buyer. Now, here's what we need to understand. What happens is in the markets, there's something called as a market maker, which is, if Chris wants to buy, let's say, XYZ stock, and Steven doesn't want to sell him the XYZ stock, but Crystal wants to buy it, there is somebody called the market maker whose job is to provide liquidity to all different kinds of market. And I think it was in last week's or the week before that when we covered that Goldman Sachs was starting to do, options and all that stuff in Bitcoin and things like that. So these guys are market makers. They have to provide liquidity. So what happens is if you go and buy one share of XYZ and there's some seller on the other side of there's a market maker, they're selling you one share of XYZ or the reverse. Now that's fine. What happens is with the introduction of Robinhood and Webull, access to options trading. Now options are a derivative. They're a leverage asset. They're a leverage tool. They're a leverage product that you can use to, use lower capital, limit your downside, and then make incredibly higher returns. So with that, there's something called as hedging, what we've talked about earlier. Very simply, when you buy an option, now the market maker doesn't just sell you an option, they actually have to go out and buy some amount of shares to balance the book. They can't just sell you an option and balance it out. It's called delta hedging. It basically means that the market maker has to go out and buy 50 to 100 shares worth of that stock every time someone buys an option. Now, what's happening with introduction of Robinhood and Webull and all that is, A, it's free. So, there's no commission, which feels great. Second, a lot of people with a lot of capital started buying a lot more options. And if we look at the put to call ratio over, historically, it's been incredibly high over the last year, like through the roof, because access to options trading has been incredibly easy. There's no barrier to entry there. So what happens is very simply that every time somebody's buying a call, now whether it be a $500 call or a $10 call, doesn't matter. The market maker still has to go out and buy an equal amount of shares to balance the books. Now, that has really caused what's called squeezes, what we learned about like with this whole GameStop thing. Some people will call it a gamma squeeze, a delta squeeze. This is where options expire worthless and the market makers let go of the stock, flooding the market with some stock, or the other way around. When everybody starts buying options, call options, call options, call options, the market maker has to keep buying more shares, more shares. Thus, if people start to buy more calls, there is a direct relationship in the increase of price. Very little, sometimes higher. So that's what's happened. So access to options trading for everybody at cheap prices has in some way affected the market, where it may not be actual institutions buying stocks. It may just be the market maker balancing their books. But eventually things do seem like they're continuing to go up. So hopefully that made sense, but that's something we can talk more about in next time. It's called delta hedging, is what basically has caused some of these massive runs that we've seen.
Yeah, and the interesting thing about that, is if we just take a trip back in time, not that long, even just a couple of years ago, when the average investor made trades, and thought, wow, I have the ability to move the market, that was just not even possible, just a fallacy, because institutions move the markets. The Bank of America, the hedge funds, all the big players were moving the markets, and the individual investor really had nothing that they could do to move the market. But in today's world, because of what you just said, the easier access, the more availability of the options, and the market makers having to cover this huge increase in options. And, Warren Buffett's got a unique take on options, but we'll save that for a later one too. So when you're actually thinking about it today, well, and you saw it, I mean, the average investor certainly can move the market. You saw it with GameStop, you see it with AMC, you're seeing it left and right. They tweet or they go on Reddit and they do this, and it is moving individual stocks. Maybe not the overall markets as a whole, but are we far off from that, where maybe eventually the individual investors pooled together, banded together through things like Reddit and social media, maybe then they are a much bigger force than the institutions. I guess we're going to have to wait and see what happens, but it looks to be going that way. But, over here, I think this chart, and I'm going to just Steve's got some great questions here from YouTube. What's going on in crypto? I promise you we're going to cover crypto. We'll never leave you crypto folks in the dark. And then he goes on saying GameStop is getting into NFTs. And the last thing he says is the market is a big casino for the rich. I don't know as if the market's a big casino for the rich. I think the market is absolutely a big casino. And it's a big casino of blackjack. Put it on, you're playing blackjack or roulette or whatever you are. Like, you got to know what you're doing, because a blackjack player that knows how to play blackjack, their odds of winning is much higher than somebody like me who sits down just for the free beer and mixed drinks that they give you, which are usually pretty crappy. So coming over here, this exhibit 11, okay, only 2%. This was strange to me, Sodi. This is June of 2021, so this is current. Only 2% of investors expect a bear market in the next 6 months. Like, that's insane. So if you look at the chart, almost 48% of the investors think the market's going to rally another 10% above where it's at now. And then you go to the 15%, you've got, what is that, almost 30%, a little shy of 30%. Above 5%, they think that's about an 8%. And then only, if you go down here to, am I reading these right? Yeah, 20% gain is like, that's crazy too. 20%. There is over 5% of the investors out there thinking the market's going to rally 20%. And then less than 2% or about 2% think it's going to fall 20%. That blows my mind. I would have literally flipped that and said that the opposite was true. But I think this right here shows you a couple things. It shows you right now we are in a crazy speculation period. We are in a period where the euphoria and the FOMO is it's at high level. I think everybody's high on this stock market just going up. But make no two ways about it. The exact same thing. Read a book, watch a YouTube video about 1929. The market took a big drop and they thought it was all over. And then institutions and the bankers, back then it wasn't the government, it was the bankers, piled money in, and all the outside investors piled money in, and it drove the market to a crazy new high where I bet you any money in 1929, the numbers probably matched this. But history proves different. Did the market continue to rally 20% or 10% or 15%? Maybe for a week, a couple months, less than a year. And then what happened after that? Game over. So we really have to kind of look at this and say, is this sustainable? Can the market continue to drive to new levels, to new heights? Stephen, what is your take on this chart right here?
It kind of goes along with what we see through history. People don't, the FOMO, the fear of missing out. They don't want to miss out. And all they do is hear all the positive news. I mean, if you turn on the news and listen to the talking heads, it's almost all positive. Like, buy this, buy that. Things are going up. Things are great. You listen to the Fed meetings. Oh, inflation's transitory. Don't worry about this. Don't worry about us printing trillions and trillions of dollars. That's all part of modern monetary theory, and that's how it's supposed to work. And this is all great news. So, you hear that enough and you start buying into it, and your financial advisors are telling you, listen, don't worry about it. Over time, the markets always go up. So even if we see a little correction, hey, don't worry about it. And they're still buying, they're still investing your money in the stocks and in equities and, all over the place. So, what's stopping it from continuing to rise? Like, when is that going to turn? Well, I'll tell you, when it does turn, it turns quick. And that's why you see that avalanche. And that's why you see that crash happen. And that's why you see the majority of Americans lose a lot of money. And that's why you see the large majority of Americans, about 95%, are not able to retire the lifestyle and at the age that they want to, because they listen to this hype and they listen to this buy-in, and it just doesn't work. It's just craziness. So this chart actually kind of makes sense in its own backwards, strange way, right?
It really does. I mean, I think you nailed it. I mean, if everybody's buying into the euphoria, the FOMO, then this chart makes all the sense in the world. It would only make sense that the general sentiment of, the overall markets, so we'll call it 98% of all the investors out there, think the market's going to continue to rally. And they'll think that way until it doesn't. And that's a perfect lead-in to crypto. Everybody that comes to what the F happened. And just so if any of you are joining us from Instagram, Facebook, all the different channels, YouTube, you are watching What the F Happened, a weekly show we do every single Wednesday at the exact same time, 9:30 Eastern. And we talk about the week in review. And we go on rants all the time. Like, you're going to get rants. And sometimes you might not like it. Good. Like, we don't want everybody to love what we say. We want you to battle us, prove us wrong. Tell us, like, it's not going to happen the way. Like, just last week when the market crashed on Friday, I went public and I said the market's going to continue to fall 20 to 30% the following week. How's that working out this week? It's not. And Sodi would have been the one to say, yes, price movement would have shown the market was going to fall, but it bounced off of that level and went the opposite direction. Now, does that mean I was wrong? Absolutely not. Did that mean I'm right? Absolutely not. I was definitely not right, and I was definitely not wrong. It's just you cannot time the market. Based on what happened Friday, I took the bet that the market was going to fall, and the market bounced. But by this week, you could see the market completely fall apart, or you could see it completely rally. 98% think it's going to rally. 2% think it's going to fall. But here's the deal. If it falls, the reason that and I want to just explain something because people do not understand this. So for those of you watching, this is our 10-10 chart. We came up with like this little rule book. 10-10 trading. This is our program we offer that Sodi teaches all about, the fundamentals of stock investing, options investing, how to hedge, and everything else. So we have this program. It's very, very valuable and inexpensive. But here's the thing. This is what your grandparents, your parents will tell you that they didn't understand until it was too late. It's called the drawdown factor. All right. So what does the drawdown factor mean? Well, let's just say Friday, the market fell. Let's just hypothetically say it fell 20%. It didn't, but I'm just making this up. If the market falls 20% and you didn't get out and you wrote it down 20%, but then the next day the market bounces back 20%, are you even in your account? That's my question. How many of you can tell me that? So any of you watching, I want to know if the market falls 20% and you ride that 20% all the way down, okay? But then the next day, the market bounces back 20%. So the market, the S&P 500 or Dow, whatever, is back to exactly where it was the prior day when it went down. Is your account back 100%? Like, did you not lose anything? How many of you can answer that question? Well, I see some stuff coming in from Instagram here, and, some people are kind of saying, I don't know. But here's the deal. The answer is no. Your account absolutely would not be back. It's called the drawdown factor. All right. So here's the deal. If you lose 20%, you have to make 25% just to get back to 20 you lost. But it gets worse. If you lose 30%, you have to make how much? 43. So we got more people saying it's even, I think. But logically, that would make sense, right? If I lose 20 and the market comes back 20, I'm even. You're not. Because you lost 20%, which means now your balance is down 20%. your balance now has to work twice as hard or harder to get back to your even, which means, and these are the numbers, if you lose 20, you got to make 25. If you lose 30, you got to make 43%. Okay, and now this one's a good one. Well, actually, let's stick on the 30. Why is it that, and maybe I see this a lot more, and Sodi sees this a lot more, and so does Steven, in COVID, when the market fell 30%, and then the market rallied and came back, people watch the news and like the market's at all-time highs, from where it was prior to COVID, the market's exceeded it. And then people get their statement in the mail and they're looking at it with kind of weird looking face going, honey, can you look at this? Did you see on the news the market was at an all-time high, which means it's higher than where it was before we started COVID, but our account's still showing a loss. Like, get that advisor on the phone and tell him he better start doing something because we're going to fire his ass. What the F is what they're saying. But what the F is on them because they didn't understand the drawdown effect. If you lose 30, you got to make 43% to get back the 30 you lost. You lose 40%, you got to make 67% to get back the 40 you lost. And if you happen to kind of lose 50% like 2008, well, you got to make 100% to get back the money that you lost. Do you understand that? Does that make sense? It's very important that you understand the drawdown effect because a lot of people think I'm just going to invest for the long haul. If the market goes down today and it comes back tomorrow, I'm good. No. If the market goes down and you ride it down, your money has to work that much harder just to get you even. Then you can push to new levels. So for all these 98% that think the market's going to rally 10% or 20%, God forbid that there's a correction where the market corrects 30%, then they got to what? They got to make how much to get back the 30 they lost? 43. Does anyone think that's going to happen? Probably not. So that's a really important topic. So we're going to move on to the next thing. Steven, anything to say, or Sodi, anything to say on the drawdown effect?
No, it's very important to understand.
Absolutely. All right. So let's see. No, we'll go higher. Yep. So Lynn's been around the campfire with us for a little bit, and so has Avery. So they both understand the drawdown effect, but most people do not. So it's important. Write that down. 30%, you got to make 43. 40%, 67. 50%, 100. Just remember those numbers because if you lose, you're not going to be even until you catch up. Let's see, we got another neat little thing here. And this one is kind of totally off topic. And all you crypto people, I've got something really cool for you. But I wanna show this because this is interesting. So how many of you follow the NCAA or any of that stuff? Any of you follow professional sports? This is kind of a good one to talk about. We're just going to spend just a quick second on this. But the Supreme Court allows more athlete compensation in NCAA. So what does this mean? I mean, Sodi sent this over to us, but the U.S. Supreme Court cleared the way for greater compensation for student athletes in a decision that may loosen the National Collegiate Athletic Association grip on college sports. So now I'm taking this at face value. Does this mean now that college, or student players can now make millions of dollars through endorsements? Does that mean that Nike can grab the next superstar before they're in the NBA and pay them $1 million endorsement? I don't know. Sodi, what's your take on that?
Sorry.
Okay.
Yeah, no, again, it's like, we've had this conversation going on for so long that should the athletes be allowed to pay, should they receive compensation and all those things like that. I think it's just, there's always been this, call it whoever side you're on, like there's always an argument for or against it. But I think this is a good thing. I think the athletes deserve more. And I think, I used to be an athlete myself, so I would definitely side with them. I do have a bias here. I'm sure the NCAA has its reasons not to. I'm sure that they think it would make things more complicated or difficult in the long run, whatever the reasoning may be. But I think I'm going to have to side with the athletes over here because the biggest argument I've heard of why athletes should not get compensated has always been, well, how do you know who to compensate fairly? Well, who's going to, what sport are you going to pay what? And I think that's great now because if, like you said, Nike, Adidas or anybody, they decide to go after, they, I think, are a better judge, and I think they have better metrics to figure out who is a better athlete and what they deserve in compensation and how it can help their brand. So I think it'll be interesting to see, because every athlete has a bigger drive now to want to be the best, to know, hey, what you're doing here is not just for your college; it has a lot more, implications. So I think I think it'll be interesting. I think it brings more competition to the game. I think it brings more fire in the athletes to be, hey, you know what? We deserve more, and if we do well, we might as well get that big check now. But again, we don't know what the full details of this are, like what is allowed, what is not allowed. But it'll be good to see, because again, the athletes deserve more.
I agree, and I'm gonna put my 2 cents in with this. Pay the athletes. Let them work hard for what they do. Steven, you're a big sports fan. What's your take on this NCAA ruling?
Yeah, I mean, like Sody said, it's been going on a long time, and it's been a fight that's gone back and forth. I can understand both sides. I mean, college is about the athlete. College is about the experience and getting you ready for the next level. So adding money to that, I mean, college is hard enough. They're still young people. There's so much pressure on them as it is. So adding money to that mix, could be an issue, a challenge. College kids, might not be in a position to make the best decisions, but they need to focus on college and the next level. Many of them, once they get to the next level, they get all that money, they start, spending on crazy things. Rightfully so. They're making millions of dollars and they're very good at what they do. But, being able to at least pay them some, and I don't think that this is going to allow for millions of dollars. I think this is just going to allow for some compensation and different things like that right now, at least. We'll see where it goes. But I think it's the right step forward right now for college athletes. I mean, they do work so hard, and so many of them have to live like on nothing because they can't make money. All their time goes to training and practice and getting better at what they do. It's just one of the downsides is, how are some of these, smaller schools going to try and compete and get athletes to their programs when the bigger schools, hypothetically speaking, would have more money to throw around. So we'll see where it goes, but in my opinion, it's a good thing. And yeah, I mean, I saw Steve real fast with the extra percentages, going back to that last one. Just a real quick way to look at it, Steve. If $100,000, you lose 50%, you now have $50,000. Well, to get back to $100,000, if you just made 50% back, you lost 50%. If you just made 50% back from 50, it takes you to 75. So you need that 100% gain just to get back to that $100,000 level. So hopefully that makes a little more sense there.
Absolutely. So here's a couple things to really talk a little bit about. Let's get to crypto, because everybody loves talking about crypto. And Sody had to get back to his trading. He's got a busy job. He trades all day. He's a professional trader. Also, he's a professional stock and options and leveraged mentor. So if you guys are interested in learning more about what Sody does, check him out at the 1010 training. You can scope it. You can check it out. There's all sorts of free stuff he does. He does free previews all the time. And you can check that out at moneyschoolrei.com/1010. I put it on Instagram, and we'll type it here in the comments. But if you guys want to learn more about how to trade stocks, how to trade options, and how to do it the right way, like the professionals such as Sody, that's a great way to get started. So here's the thing, let's talk crypto, because everybody sees what's happening in crypto. China is clamping down on mining. And if anyone doesn't know, mining is giant computer banks, I've seen mining operations, but basically they just lots and lots of data, and they try to find, extract coins. Now, if you're talking about crypto, or you're talking about Bitcoin, there's only a finite amount of coins, which is why crypto is so highly valued. If there's only so much of something, the value is related to supply and demand. Same thing with gold. Gold is different because it's tangible. Crypto is not tangible. Bitcoin is not tangible. It's a digital asset. So there's really nothing behind it outside of what your thoughts are about it. So when you look at cryptocurrencies, okay, I don't care if it's Ethereum, Dogecoin, I don't care if it's Bitcoin, you have to just understand that it's an investment like everything else. Bitcoin is not the next gold. Some people love saying, oh, Bitcoin's completely, it's what you'd buy to hedge against inflation. It's what you'd buy to hedge against the markets. Wrong. If you have been following Bitcoin, or pretty much any of the cryptos really for that matter, they are trending the market exactly. I don't know whether the market's following crypto anymore or crypto's following the markets. I would almost say the markets seem to follow crypto. when Bitcoin and all the cryptos fall apart, the market seems to fall apart, and vice versa. It's a strange dynamic going on. It's not dollar for dollar or exact for exact, but it's pretty good or pretty easy to see that pattern. So here's the thing, we talk about this all the time. Investing is a very simple thing. It revolves around some very simple principles and simple rules. Now you can make it very complicated. You can learn about all the Greeks and the MACD, the stochastics, the momentum charts. You can do all that. Technical analysts do that, and you can too. But really just keep it simple, right? Just like, that movie, Keep It Classy, San Diego, or whatever he said, Ron Burgundy. You remember, I just watched it the other day. It's top of mind. But keep it simple. To make money, all you have to do is you have to buy low and then sell high. And if you buy low and sell high, you can't lose money. So then how do we do that? Well, we got to figure out what is low. Right now, the markets are all at a high, but let's talk crypto, or let's talk Bitcoin. What is it? What is low for Bitcoin? Some people say 0, but that's pretty low. Others say 10,000. Some people say 20, but let's just talk about the low inside of this pattern. The pattern is the support and resistance. So just think of in your house or wherever you're standing right now, look down. What do you see? The floor, right? So if you throw yourself in the air and you just throw your arms and your feet up, what's going to happen? You're going to crash into the floor. You're probably not going to go through the floor to the next level. You're just going to smack the floor and it's going to hurt a little. And then you look at the ceiling. Okay. To hit that ceiling, you got to jump off something. So jump on your bed and start jumping real high and your head hits the ceiling. It hurts a little, but you didn't go through the ceiling. Okay. Trampoline or couch, whatever your flavor is. In the markets, in every single stock and every single current or crypto, there is a floor and a ceiling, just like the room you're in today. So what happens? Well, the stocks trade between that floor and that ceiling for a period of time. Let's just picture yourself. You want to get into the attic, but you have to go through your ceiling to get into the attic because nobody put one of those little trap doors. So you want to get into the attic to see what's up there. Somebody left an old computer that's got $35 million worth of crypto, and you got to find a way into that attic. So you get on your bed and you start jumping as hard as you can, and you're hitting your head against the ceiling. So you put a helmet on, and as you hit that ceiling, every time you get more momentum and you keep hitting it harder and harder. And eventually you crack the drywall. Then eventually the drywall starts to fall apart and your head starts popping into the attic. And then you do one last hard bounce and boom, you hit the ceiling and you're in the attic. Stocks work the same way. Okay. They will trade within that pattern, support and resistance, they call it. I'm going to say your floor and your ceiling. They bounce off the floor and they go to the ceiling. And if they hit the ceiling enough times, they will go into the next level, i.e. your attic. The same thing for the floor. If you started doing that with the floor, eventually you'd go through the floor to the level underneath you. Stocks do the same thing. So for Bitcoin, a good floor to look at right now is 29,000 to 30,000. So to say relative to the timing, that would be the low point. So right now, it's not the lowest point, but it's a low point in this range, 30 grand. Okay. So when when Bitcoin went from a little over 40,000, which 40 is the ceiling and 30 is the floor. Let's keep this simple. Okay. When it bounced through the ceiling, it didn't like the attic. It was cold. It was damp. It had a musty smell. So it came back down to the floor, but it hit the floor with a lot of oomph because it was higher, right? It was in the attic and it hit that floor and it started going below it, made down to 29. Most good investors or anyone buying Bitcoin, they said, wow, that's a buying opportunity. That's a low point in this range. So I'm going to buy that Bitcoin at that level.
Yeah, Chris. But yesterday when I hit 29,000, I sent you a message and I was like, time to buy, ? And you responded a couple minutes later, just bought. So that's what
I'd already bought before you sent that. Right. I'd already bought before you sent that. But the other thing too is, it's one thing to buy it at 29 or 30. But if you buy something, anything, I don't care what you buy, you should always have an exit. You should always have a plan to exit it. For example, if you buy a car today and you said, you know what, I would sell this car if somebody gave me 5,000 over what I paid. That's your exit. Then you just got to find someone stupid enough to buy your car 5,000 over what you paid for it. Maybe that's not stupid at all. So when you buy at 29,000, like we did yesterday, and I'm not making a suggestion or recommendation or anything else, I'm just telling you what we did because of this support and resistance level. So what is our exit? Where do we get out? It's simple, 40,000. Literally, I grab my phone when it hits 40 and I click sell. And you know what the magic thing is? We make money. Holy shit, what the F? We just made money doing that? That simple? That's all it took? Yes, that's all it took. It's all it takes. Look at any stock out there, any ETF out there, and you will see those patterns and those ranges. And if you don't know how to see that, get with Sodi, get in 1010 and learn, because that right there could set you free. I'm not going to say it's going to answer all your questions because that's just the earliest level. But like, then, you know, the funniest thing is when me and Steven go public with this stuff, when we say, hey, we just bought, you know, Bitcoin at 30, you know, or actually the most important one, nobody really comments on buying it. But then we say we sold it at 40 and people start saying, are you crazy? Why would you sell it at 40? And we kind of look at each other and we say, because we made money. And everybody else says, yeah, but you could have made more. If you just held it, you could have made more. It went to 60,000. You gave up $20 a share. Me and Steven would sit there and say, no, we made money. Maybe we could have made more. Maybe we couldn't have. It doesn't matter. We followed a set of rules. And because of those rules, we just followed Warren Buffett's. We bought low and we sold high. And because of that, we didn't lose money. It's an awesome formula that nobody follows. Everybody does the opposite. When it gets to 40, they're like, because, you know, hey, let's talk about Bitcoin. You know, it's all over the news. Are people super excited about Bitcoin right now? No, they're like a little nervous. They're like, oh, you know, I think we were wrong about Bitcoin. I think it's going to go to zero. China's not going to allow mining. Who cares? There's still this finite amount of Bitcoin out there. You know, all these things, all this news, you know, it's almost like manipulates your mind. And you're like, oh, maybe it's bad. Maybe I should sell everything at 30. You know, that's what they want you to do. Hell, I want you to sell at 32 so that I can buy yours at 30 and then I'm going to sell it at 40. But then the people didn't buy at 40. They buy at 42, 45, 50 when it's going up and up and up and they think it's never going to stop. Hence, a bunch of people bought it at 60. How do you think they feel right now? Well, most of the people that bought at 60 are probably like, well, honey, we made a mistake. Sorry, we have to leverage the car or the house. We might have to sell the house. Tell the kids to pack the boxes just in case crypto doesn't or Bitcoin doesn't bounce back up to 60. Just warning you, sweetie. Like, how does that feel? Not good at all. Steven, what do you have to say about that?
No, I'm nothing, man. It's wild. I just sent you a picture of the different tranches that Bitcoin's gone through since its inception, of every time before it halves, like the markets, because Bitcoin halves all the time, right? So you got to take a look at your phone when you get a second, look at that. But it sets up a pretty bullish picture of Bitcoin going into the future over the next few years. So
did you text it or did you email it?
I just texted it to you.
Oh, you should have emailed it. I could have put it up on the screen.
Yeah, it's just interesting. I mean, I'll have to get more into that maybe later on, the long-term outlook. But for right now, you know, like you said, find your range, set your roles, and take advantage of it. I mean, if you would have, you know, Chris, you posted a video on this, I think 2 or 3 weeks ago, you know, about talking about the 30 to 40,000 range. And we had students that were telling us, hey, we decided, hey, that sounded like a good idea. So we did that. We bought at 30, we sold at 40. Yesterday, I had him email me, hey, we're back to 30. We're buying again. We plan on getting back out at 40. And then once we see those levels, those resistances, those, you know, those different, that ceiling that Chris was just talking about, once we see that break through and maybe get up to the next one, then we'll start playing that game again. Who knows where that is? Maybe it's 60 and 50, you know, or wherever it is, but make your rules. Now, if you're in long-term, then buy it and forget about it. Dollar cost average in if you want. If you're a long-term Bitcoin believer and think it's going to be $100,000 at some point in the next several years, then just dollar cost average in and don't look at this stuff. Don't watch the market. Don't have it set up in your phone, on your watch, where it tells you all day long the price of it. Don't do that stuff. Put it in a Roth IRA, in my opinion. Get all that tax-free growth out of it, but just forget about it. But if you're actively making money, like we're talking about right now, then follow those rules. Don't get greedy, and you'll make money.
Yeah, you know, or another suggestion is, you know, get around our campfire. Come to our wealth webinar series today at 1 p.m. Join us for that. And you will learn a whole lot about being your own bank. And when I say be your own bank, what am I talking about? Well, privatized banking, the infinite banking concept, how to leverage your 401k and use loans to make you go make you more money today so you don't even have to wait for it, how to use the hidden equity in your house that money that's sitting in your rafters because you got equity in your house, how to make that money go to work for you. Like, listen, folks, there are so many ways to make money and build wealth, but you can't be in a hurry. Building wealth takes time. Everybody's in a big rush right now. Everybody wants to get rich yesterday, and I understand it. Listen, don't we all? But building wealth is a marathon. It's a marathon that you got to work at consistently and persistently, and those that do, like Warren Buffett, make a ton of money. You know, Bezos asked Warren Buffett, he said, you know, Warren, you have such simple rules and so many unbelievable ways for people to make a ton of money in the market. Why doesn't everybody do what you do? Why doesn't everybody just follow what you do? His answer was genius. He said, because everybody's in a rush. That's it. That's the only reason people aren't getting wealthy is because everybody's in a rush. And when you're in a rush, you make stupid decisions. You buy high, you sell low. Like, you do the opposite of what you should do because you damn well need to slow your ass down and just focus on being consistent and persistent with a goal and some rules. So freaking simple.
Yeah, I'm excited for today's wealth webinar at 1 p.m. Eastern. We're getting into hidden equity. And right now, there's never been more hidden equity than in the last probably 20 years. Homes are at all-time highs. Stock market's at all-time highs. There's a lot of money out there right now, and people need to know what to do with it. So even if you don't own a home, even if you don't have that 401k, guess what? I guarantee you know somebody that does, and I guarantee you that person would be open to find a way to use something that they didn't even know existed, to use that to make their car payment, or to be able to go out there and go on a vacation for themselves, and you can teach them how to do that, and you can make it happen for them, if not for yourself. And if you have a home, if you have a job, and you're looking to move some of this around, make sure you join us today. It's going to be really, really good.
Absolutely. And Stephen, if you could put a post up for how they would join us for today's.
I can't make posts on here on StreamYard, but I can just tell you, just go to chrisnaugle.com, click on free resources, and then the wealth webinars right there. You can register if you're not registered. And then once you register one time, you stay registered. So we'll remind you each week. If you can't watch live, as long as you're registered, we email you the recording afterwards so you can watch it on your own pace. So just go to chrisnaugle.com, click on the free resources, and it's right there on the page.
Perfect. Yeah. So folks, like anyone on Instagram, just go to Chris Naugle. It's spelled NAUGLE.com. And then once you're on there, just click Wealth Webinar Series. It'll cost you absolutely nothing but your time, and you will be able to spend an hour and a half with us. We'll teach you how to make your money work harder for you. We'll teach you the secrets of the wealthy and how you can crack the code. Literally, no advisor is going to teach you what we're going to teach you because there's no money in it. That's why it's called cracking the code. There's no money in them teaching you how to be the bank because that's making them, you're basically putting them out of a job. They can't manage your money because you're learning how to manage it yourself. And you know, the best part is you are always going to be the best steward of your money. Nobody's going to care more about your money than you are. But you
let me say this.
Yeah.
Steve Smith wrote on here, tomorrow is not promised. People live for the now and want that instant gratification. What fun can you have at 65? Absolutely. But let me add this. If you're 65 and all of a sudden you're going out there and you're having a great time and you're not properly set up or planned for that, guess what's going to happen? You're going to run out of money. Especially if you have all your money in the stock market and you plan on living off that. When this crash comes, that money's going to evaporate. It's gone. And how much fun are you going to have having to go back to work at Walmart or have to go back to work somewhere as a greeter to an entrance of a place, right? That's not a lot of fun for retirement. So let's make sure we have your finances in order. Today, we'll teach you a strategy. We should get to it on the wealth webinar called creating predictable, guaranteed income for the rest of your life. And that's how we set you up. So no matter what happens in the markets, whatever happens else in life, you know you can go out there and live the retirement that you want and not worry about running out of money. So let's get you educated and set up and then go out there and enjoy it because you're absolutely right. Tomorrow is not promised. And this is no dress rehearsal. You got to get out there and live your one life right now.
This is definitely not a dress rehearsal, folks. You better take this stuff real serious. I put the post on Instagram and I also put it on YouTube and all the other channels. So just join us. Oh, and if you're working and you can't make one, you're thinking, darn it, I can't make 1 o'clock. We'll send you the recording. Just register. You got to get in the game before you can play the game. We'll send that to you. And let me throw out one more thing before we get to the final wrap up. This is something really, really special to me. And, you know, John and Lori and a bunch of others are actually already part of this, but we're doing a once-in-a-lifetime event, okay? It's August 27th to the 29th. It's at my house, okay? My brand new house that we just bought. We're doing it down in a very cool environment. But we're doing a mastermind, but it's not a mastermind that you're going to come to learn. It's a mastermind you're going to come to make memories. What kind of memories? Well, first off, you're going to be surrounded by 100 millionaires, the guy that bought the Yankee Stadium, the coach of coaches who sold and exited a business, many businesses, at hundreds of millions of dollars. You're going to have, who else is going to be there? We got a celebrity. I can't tell you who it is, but we've got a celebrity that was in a Hollywood movie, a very popular one, a football movie. But not only was he in the movie, he was who the movie was written about. We have hired him to come out and speak to just 25 people. That's it. There's only 25 seats at this event. It's called The Experience. And we've rented out a theater where you're going to hear from this celebrity. You're going to hear his story. You're going to hear the story that the movie was written about and that the movie he played in was done. It's going to be phenomenal. I've heard him speak before, but you can only take part in that by joining us for that event. So we have 25 total seats. As of, I believe today, we have 14 or 16 seats left. That's it. It's August 27th to the 29th. I will put the link up. It's actually quite easy. It's Stephen, actually, if you could, I'm going to put the link up. Stephen, can you cover a little bit about this fear and greed index while I let everybody know how they get to be part of the experience at my house?
Yeah, definitely. The experience is going to be awesome too. I'm super stoked for it. So it's going to be a lot of fun that weekend. And I hear we're starting at 6 a.m. and going all night. So we'll see what goes on. All right. So let's see. What emotion is driving the market now? The fear and greed index. So we bring this up every week and kind of close out with it. This just shows a general opinion of an emotion of what's going on with the markets, with the general public. Are people feeling fearful, or are people feeling greedy? Meaning, are people kind of backing away and starting to look for alternatives, or are people all in, buy, right? So last week, I think we hit 50%. Previously, we were down like 35% over in the fear side. But over time, so things were going up and up. People were getting greedier and greedier. This last week, the market fell almost 1,000 points for the week. So, it looks like this new index, we're creeping a little bit back into the fear, but we're still in the neutral rating. Anything between really 40 to 60% is considered neutral. So people are, kind of just, they're feeling optimistic about things, but they're, starting to say, hey, what is going to happen? Or, hey, if we can lose 1,000 points in a week, like, what if we do that several weeks in a row? So they're starting to maybe think a little bit from that 50 back over to the 45, but overall still in that neutral position. So we'll see where this goes. But that kind of goes along with everything we've been talking about today and the way people are looking at these markets.
Absolutely. So I just put the link up for the experience for the 14 seats. I can't remember, 14 or 16 seats in there. And you guys can join us at that. And like I said, there's only going to be a few people allowed there. But yeah, I think the fear and greed, we've been tracking this very, very closely, trying to see where we're going to go. And this, you can see now, we were just starting to kind of get over into the extremely good sector. Now we're kind of coming back, and probably because of Friday's pullback. And you can see it follows these patterns. So just remember, every stock has a support and resistance, a pattern you can follow. It doesn't matter whether it's Bitcoin or Ethereum or Dogecoin. God, if you're buying Dogecoin, I still don't comprehend that one. But check it out and make sure you guys get part of it. And Stephen, anything you have to say in closing on today's What the F Happened, the weekly show where we talk about the craziness going on in the stock market today?
Yeah, I mean, all I want to say is stay frosty, right? I mean, be ready. Just because we saw this bump at the beginning of the week back up from the drops from the losses last week in the stock market, anything could happen, man. It's fair game out there. GameStop's still over 200. Bitcoin's making a bounce from 29 up to 35 again. It's all craziness. So just stay frosty, stay protected, get educated, get prepared. And maybe next week we'll start getting into real estate, because you guys look at all these charts and these lines and these ups and downs and these daily moves and all over the place. And the stock market just drives me crazy. So I kind of stay back a little bit. I leave that up to you and Sodi primarily. But if you want to talk real estate markets, what I think is going to happen with real estate, maybe we'll do that with one of these WTF weeks as well one time. But yeah, till then, till next week, we'll see you guys at 1 o'clock today for Wealth Webinar Wednesdays. It's been a lot of fun. Thank you.
Absolutely. And we're going to close out with the meme. Oh, you look at the metrics? Well, I decide if a company is doing well by seeing if they're in VC's Twitter bios. That's how we open today for What the F Happened, and that's how we're going to close out today. So thank you all for your comments. Thank you for joining us. This show happens every single week, so make sure you join us next week, and we'll have some fun. Until then, stay frothy.